Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from global tax policy to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 compliance, provision, and modeling calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in Prague, Czechia, at PwC's Global Transfer Pricing, Customs, and Indirect Tax Conference, where I'm excited to have Will Morris back on the podcast. Will, who doesn't really need an introduction on this podcast, is PwC's Global Tax Policy Leader. Will, welcome back to the podcast.
Doug, thank you. And I simply cannot believe you keep inviting me back, but here we are.
I cannot resist, and I've got some good topics for you on this podcast.
Well, you know I'll give it to you straight.
I know you will, Will. And maybe a couple, before we start, first of all, we had the opportunity to kind of co-moderate a 2-hour panel at the conference today. And I was absolutely thrilled that about 3/4 of the way, you made our entire audience of about 600 people stand up for the 7th inning stretch. And I'm so excited that I feel like all this baseball talk that I've been wasting people's time on with the cross-border tax talks, maybe it's taking off here in Europe.
I put cricket aside. I could have said 2 hours is very short compared to 5 days, so stop complaining. But no, I thought 7th inning stretch. We need to get people up there, sort of waving their hands, jiggling their feet, but only you sang.
I was the only one to sing Take Me Out to the Ball Game, which I will not be doing on today's podcast.
That would be very kind.
Yeah, apparently you could actually hear me sing as I was doing that.
It was a good innovation, I think.
I thought it was fantastic. All right, so we're going to touch on Pillar 2, but I would like the focus of this podcast to be beyond Pillar 2. I think we're both have fatigue at this point as we're waiting to see what happens with this G7 agreement. The geopolitical situation continues to be very complex. That's probably the understatement of the podcast. But you had mentioned a point during the conference that I thought would be great for our listeners to hear related to Pillar 2, and then we'll move on from topics. And we've talked about this before on prior podcasts, but just given the current political situation, how does trade policy and specifics of the negotiations that are taking place with the EU, China, elsewhere, impact the potential G7 agreement and the ability for the inclusive framework to actually agree to this side-by-side proposition?
Right. Well, okay. It's a great question and should take up the rest of the podcast, but I'll try to make sure the answer doesn't. So look, I mean, we've talked about trade before, and one of the things that I said this morning, and I've said before, is that the past 7-8 months have destroyed any illusion. And it was an illusion a bit before January the 20th, but certainly since then, that tax is in charge of tax. And, tax is over here. It's sort of, we have a tax. We talk to each other about tax. We go to the governments, all the rest of that stuff. No, what has happened particularly since January 20th, although this was true to a certain extent before, is that because of the importance of trade, particularly to the US administration, but actually also, because of these, mega trends that we talk about in terms of geopolitics, but protectionism, the global fiscal crisis, all of these things have made trade much more important because, people are thinking, okay, well, firstly, how do we attract stuff in? But also, how do we keep in what we've got and protect what we have and raise more from it? And, because in particular of the very sort of, if I can put it like this, front foot forward approach of the US administration on tariffs and trade, it's become also a much more complex thing. But what I was talking about particularly this morning was, so you have the G7. Obviously, the US is one of those. Japan is another, Canada, but then the rest are European countries. And, one of the big things which has been going on over the past 5-6 months now is EU-US trade. And it looked in the summer when President von der Leyen of the European Commission and President Trump met at Mr. Trump's golf club in Scotland, that had all been sorted out. But as with so many things, it was a bit of an agreement to agree. And since then, various problems have emerged. So the first was President Trump posted on social media 5 or 6 weeks ago now that he didn't like the way American technology companies, tech companies, were being treated, particularly in relation to the Digital Markets Act and I think the Digital Services Act. And this has been portrayed in some cases as being about free speech, in other cases about very heavy regulation. He also talked about DSTs, which we're going to come on to in a sec. So that was point number one. And it looked like that might be an issue. And this obviously is something that the Europeans feel very strongly about, particularly in relation to the Digital Markets Act, because that's not about tax. It's about how information gets used, how companies operate in Europe, all of that type of stuff. Okay, so that's point one. Point two is we heard a couple of weeks ago that in relation to the actual trade agreement themselves, and this was not from the president, this was from the negotiating documents, which probably I assume came out of USTR, which was that the US had made representation, shall we say, that the burden which was placed on American corporations in relation to sustainability reporting, and in particular, not CSRD as such, but this other directive, CSDDD, so the Corporate Sustainability Due Diligence Directive, which requires a staggering amount of reporting, that placed too much of a burden on US businesses, and that should be part of the trade negotiations. Now, the EU didn't agree to that. So that's point number two. And then, this morning, reading in the newspapers that the US and Qatar, the Gulf state, had made representations in a letter to the EU saying, look, again, the burdens that you're putting upon us in relation to CSDDD are going to make it very difficult for us to fill that 20% gap in LNG, liquefied natural gas, that you need to make up for the Russian gas that you're no longer getting. But also, they said, and this may affect the US-EU trade agreement. Okay, so put all those things together, it doesn't look like the US-EU trade deal is as set as you might think it was. Last year, we might have said, okay, well, what are you talking about? So what? What's that got to do with tax? Well, the answer is, we also need, in particular in relation to Pillar 2 and the directive, we need the EU to be on board for these changes. We need them to be on board for the G7 changes. And if it doesn't get out of the G7, it sure as heck isn't going to go to the inclusive framework. So you can see a situation where if things get tricky in trade, the Europeans have already talked about using the Anti-Coercion Initiative, which would allow them to deny deductions on royalty payments, for example, but also the Foreign Subsidies Reg, which we've talked about before. You can just see how all of these things interact. And it seems, how can I put it, unlikely under those circumstances that a bunch of European governments are going to go to their legislatures and say, hey, just ignore that trade stuff for a moment. Can you pass this legislation which will, as it will be portrayed, let American companies off the hook? So again, the interactions of all of these things need to be taken into account. And it is a very dynamic situation. So I just think, people need to bear in mind that tax is not this thing which exists in a bubble over here.
Oh, come on,
There's
Will.
No.
I want to live in my little bubble here.
You can live in the bubble, Doug, and I will protect you from the outside.
Thank you.
But this is about, what do we call them? Mega trends, whatever you want to call them.
Yeah.
All of these things coming at you the whole time. And it shows, and we talked about this morning, that you cannot operate a tax department imagining that the rest of the world doesn't exist. Because, if you only think about your C-suite, that's exactly the questions they're asking you as well.
And to provide listeners some context, we're recording this in the last week of October, towards the end of October. So we'll see how all this plays out.
Things will have changed 100 times.
Things could change. I mean, that's one of the challenges with recording this podcast now is stuff is just so dynamic that stuff gets out of date quickly. But by the time I will be shocked if we have a G7 agreement or any administrative guidance on a side-by-side by the time this comes out. But the point that I think is just really important for me that I took away and for listeners is that this is a lot more complex than, is guilty your necktie academically equivalent to the Pillar 2 regime.
No, and don't get me wrong, those are important points.
Of course.
In relation to the technical discussion, but there is a bigger discussion going on above and beyond.
Absolutely. And those politics and other policy issues certainly play a role. And I mean, there's just the inclusive framework is big, and to try to get consensus, which generally requires unanimous consent of all of these various stakeholders, is remains to be seen.
So generally, they managed to achieve consensus in the past by using a steamroller, but my intelligence is the steamroller is broken.
Yeah.
So we'll see how that goes.
All right. So in relation to
beyond Pillar 2.
Yeah. So let's move beyond Pillar 2, and we'll hit a number of topics. But I've been in Europe for a couple of weeks, so talking to a lot of our policy team, and one of the initiatives that is currently sort of on the radar for the EU is EU Simplification Initiative. And I think this even goes beyond tax and really trying to drive innovation and investment. I remember I'm in my little tax bubble here, Will.
You're doing well. Keep trying.
Thank you. Like, I want to understand, about the rules on the anti-hybrid rules, for example, on the BEPS action items from ATAD 1 and ATAD 2. But maybe you can explain to me and the listeners why EU simplification, or whether it's an oxymoron.
Well, let's hope not, is the answer. I will put on my not much used these days optimistic hat just for a second. So look, I mean, just to scroll back about a year, basically. So Mario Draghi, former Italian Prime Minister, head of the Central European Bank, put out this really, really, really good report with many recommendations about what Europe needed to do. But the basis of it was, guys, we're not competitive. We just can't operate in this world. We need to invite investment in. It's the old Walter Wriston thing, sort of capital goes where it's invited, stays where it's welcome. We need to be doing those things. And then, this sort of rather sad little factoid came out a week or two ago that like 14% of the Draghi report had so far been enacted, which, as you say, sort of points towards the oxymoronic side of the equation. But there are things in the works to try to do some simplification. Now, it's difficult. It's difficult because, some governments just don't want that simplification, but also you're talking about 27 countries, and one of their ideas is to have a 28th regime, which is, something which operates straightforwardly, beyond the 27. Obviously, to get to the 28th regime, all 27 have to agree to it. So you can see the problems there. And they've started to talk about that, but with no tax element so far. So here what they're talking about is what they generally refer to as an omnibus, which is a large piece of legislation which does a lot of tidying up. And, TaxUD, which is the European Tax Directorate of the Commission, has been, out in the field looking at various things. They've been talking about tidying up the Parent Sub Directive, and the Interest and Royalties Directive, and those types of things. But what we got earlier this week was the EU work plan for the coming year. And there are actually a couple of tax things in there which are tidying up. So sometimes referred to impolitely as zombie files. But the one on the FTT, which has been around since, a very long time ago when I was at GE, the FTT using enhanced cooperation has been withdrawn.
What is the FTT?
Sorry, Financial Transactions Tax. Sorry, which was, the idea that you take a very small sliver of every transaction. And it never got support amongst the 27, so then they were trying to go down to this enhanced cooperation of a smaller group. They never even got there. So, it didn't quite die. It wasn't really living. So they've pulled that. There's also one relating to what they call DEBRA, which is the debt equity bias reduction, which essentially was
impressive. Well, you've got all these acronyms down.
Yeah, well, I'm not quite sure what the A stands for.
That's all right.
Anyway,
we'll give it to you.
Yeah, thank you. Close enough. Which essentially was trying to, equal out the bias between debt deductibility and nothing on equity. And, that goes back to our ideas about, giving notional deductions on equity. Anyway, that never really got very far either. The Unshell Directive, which was this one about shell companies. It started off horrendously complex and only got marginally less complex. But was eventually trending, in the end towards not very much at all. So they've pulled a bunch of these things, and those look quite good. But in a sense, those were new things which are going to be imposed anyway.
Right.
So what we're not talking about yet is simplification. So that remains to be seen. And let's hope. But these things do tend to be a one-way ratchet. So we could see some improvements. But equally, there are lots of people saying, well, we still need to tighten up on this and we need to tighten up on that. You have the Parliament, which is, it's a serious body, but it is generally suspicious of taxpayers. And therefore, what the Fisc Committee does, for example, the subcommittee under the Econ Committee, which looks at tax, generally, is less keen on pulling back on some of these provisions. Now, they have been looking recently at things around dispute resolution, so that's a plus. But again, if you had to choose in the simplification category between dispute prevention and dispute resolution, you'd rather have dispute prevention, because that means that you kill the problem, or the problem doesn't arise because you've prevented it from arising, as opposed to having to resolve it after it's arisen.
Yeah, and we've established the bubble that I live in from a cross-border tax perspective. I mean, that is the name of the podcast. One of the things that I'm particularly interested in now that, Pillar 2 is enacted, has been enacted in the EU, is there really a need for, some of those rules that came in with ATAD2, the CFC regimes, for example, the anti-hybrid rules, and just the complexity. And one of the points that has been made, I'm going back to the G7 agreement. I said we were moving past Pillar 2, but is the comparing the U.S. system to the European system, and if there is a side-by-side agreement, does it make European companies less competitive, and even just from an overall compliance perspective? And I mean, the U.S. does have its GILTI system as well as Subpart F for certain types of income, but it's on the same tax base,
right,
to be very clear.
Well,
right?
It has CAMT as well. Though,
right,
so.
and there's CAMT, absolutely. But just from a European simplification base, there's really sort of two separate tax calculations that need to be done now for Pillar 2, as well as each of the domestic rules that were enacted as a part of ATAD 2. Do you see any hope that there could be some simplification in that respect?
I won't be holding my breath, is the short answer. Look, I mean, there's a split screen thing here, which is that, at one level, everybody knows that these things are overlapping. At another level, I'll be relatively generous here as well. I mean, I worked in the government. I know that part of your job, or you think that part of your job, is to sort of see ghosts. And that's what happens here. People say, well, we agree that this is now the main provision, but this thing may prevent other things from happening. And, given the narrative situation that not just business has been in, but actually governments have been in. I mean, recall those, hearings from now, 12, 13 years ago, the Public Accounts Committee in the UK, where HMRC got its head handed to it for actually having done a good job, in terms of doing real-time stuff with taxpayers and actually building confidence. It was, deemed to be cozy. Under those circumstances, there is nothing to be gained by doing the hard work of repealing unnecessary anti-abuse rules, because you'd spend all that time, and then if one little thing goes wrong, you'll get blamed for repealing them. So the whole institutional imperative, the whole institution momentum, is just to keep as much as possible. And to the government, to a certain extent, they're seen as cost-free. So while I would like to believe that this will happen,
yeah, it's fair. And but the thing, if the policymakers do listen to this, is that I think there is an underestimation for the amount of the cost to taxpayers from a compliance perspective.
Let me stop you there. They don't care. They have never cared about that.
Yeah.
Never, ever.
And this idea that everything can be automated and everything can be pulled from the systems, I mean, I wish that were the case, given all the effort that I've put into, and my team has put into this.
Okay, well, let's just take a brief step to the side there, only brief, which is that, there is a lot of talk now about using AI in this context, and tax authorities using AI, and of them essentially pulling from the ecosystem and presenting taxpayers essentially with a filled out return. That's an interesting prospect, and one that is clearly being talked about. But you think about all the problems with that, because that upends the way that, that the system has worked under self-filing now for.
I absolutely understand the theory. But as somebody who has spent a lot of time sort of building, our Pillar 2 engine, and the challenges that's going to have, the tax authorities are going to have, are the same challenges that the taxpayers have. Is that this data is not sitting in like some magic data lake. There are, a number of most taxpayers have multiple ERP systems. Half the data, for example, that's required from Pillar 2 is outside an ERP system. So a lot of us are very excited about AI and the opportunity to be able to gather data, transform the data. But the fact is like to be able to gather and transform, you have to have it, you have to actually have the data to start with.
I agree. I mean, we had this conversation with governments 10 years ago plus when we were talking about the original CBCR. And I said to them, look, you imagine that companies have this. I was at a company at the time. I said, you imagine companies have this information. It's like a deck of 52 cards. You can do it by color. You can do it by, sort of rank. All you need to do is reshuffle them on the table. I said, actually, ERPs, you want to change an ERP, it's like ripping them out of the wall.
Even if you have one ERP, and most taxpayers have multiple ERP systems for a variety of different reasons.
So this is that was a slight step aside. But the idea that these problems can be solved with technology is at best half right.
Yeah. And I'm not saying that we won't get there at this point, but again, the starting point is the challenge. I absolutely see the vision and the hope, and frankly, that would make compliance a lot easier. But again, the starting point is the most challenging. All right, so we're going to move past EU simplification. I'm not sure that you convinced me it wasn't an oxymoron, but listen, we all have our fingers crossed. So let's move on to, and you already teased this, digital service taxes. Where are we broadly on the DST debate? I know, for example, Canada pulled their DST. That was big news, obviously, for U.S. taxpayers. And of course, the big U.S. taxpayers and technology companies are right in the crosshairs of this. What are you seeing just from a global trends perspective on DSTs?
Right. So again, just to sort of set the scene on this, most DSTs, well, the DST activity stopped when the Pillar 1 activity sort of picked up. And the EU obviously withdrew from its DST idea. I mean, not that it had got the 27 votes it needed, but they withdrew from that. And other countries just stopped. I mean, the countries which had them, lucky them, carried on collecting on the basis that, when Amount A eventually came into effect, i.e. never, they'd give a credit for it against regular tax. So, Canada obviously got a little fed up that they hadn't been able to jump the gun, so they jumped the gun anyway. Not terribly successfully, as it turned out. But, equally, what a number of countries said, for political reasons, because their citizens, or at least sort of some pressure groups inside of those countries, are saying, why don't we have a DST? They've got a DST. Why don't we have a DST? So they said, because we're negotiating Pillar 1, and, when Pillar 1's in place, it'll all be fine. But if Pillar 1 doesn't come in, then we'll do something about it. Well, at this point, it's pretty clear that the Amount A convention ain't ever going to happen, ever.
We've been saying that a long time.
We have been saying long, but that's not what is being said still in some circumstances. I mean, everybody knows that were the plug to be pulled, Amount A would not happen. But that it is convenient for countries and for some international organizations to pretend it's still there in order to avoid the hard task of talking about DSTs. So I think that's one of the reasons why we actually haven't seen a huge amount more activity. Another reason is obviously the robust response, or at least robust approach the US administration has taken to things like this. That said, even within the EU, this year, Poland in particular is, very recently in the past week or two, again, end of October, in the past week or two has reaffirmed that it will pass its DST by the end of the year. That they were already warned, to the extent it was a warning, by the US ambassador back in the spring that this would invite potential retaliation. Belgium has also been talking about it. The EU has tried to stay away from this. But I think there are clearly some countries which are thinking about it because the original, as I describe it, the original Pillar 1 exam question has still not been answered. It was no way it was answered by the Amount A Convention. Right. But essentially it is, how in this digitized world, and this is not just about tech companies, but how in this digitized world, when you can create value, earn profit effectively in another country without physical presence that touches the 20th century rules, do you tax that profit? And it is a question which deserves to be properly answered. Unfortunately, the process was never set up to answer that question. Right. But that question remains. And until somebody comes up with a better idea, DSTs are going to stand in. DSTs obviously also have the advantage that almost all of the large tech companies we're talking about are US, and therefore the burden falls on somebody else. Well, of course it doesn't, because the incidence generally falls on consumers. Again, put aside that inconvenience. And interestingly, the Polish minister said that he had, his ministry had data which showed that, I can't remember what it was, I think it was 60 or 70% of the revenue would actually come from non-US companies. I find that a little hard to believe, but who knows? So, DSTs are still around. I think we're unlikely to see an explosion in them, but that in part is because of two of the other things we're going to talk about in a second. So I will.
Yeah, I'll be interested to see as far as how the DST stuff shakes out, particularly in the context of with the G7 agreement and the looming possibility that Section 899, the revenge tax, could reveal itself again.
Right. Although, remember, with 899, the DST part of it was pulled out in the Senate version.
Exactly. That's where I was going. But obviously there was the House version, then there was the Senate version, which was significantly different.
Yep.
Who knows what version 3.0 could potentially deal with. And if there is proliferation of DSTs, do they end up grabbing from the House version or some aspect related to that?
Again, just two more little points on this. The first is, go back to what I said when we were talking about the EU trade stuff, which was President Trump in that social media post did mention DSTs as being discriminatory. So obviously that, that got his attention 6 odd weeks ago. And, I think people had thought when the UK-US deal would be done that would be part of it as well. So who knows? We could see 301 was the US trade section, which is used before to
use
talk
tariffs
about
as to retaliate.
So again,
against
we could see those being reinvigorated. There are a number of ways this could happen.
Okay, so let's move on to a related topic, substantial economic presence. Significant economic presence. Sorry, not substantial.
It's an SEP.
SCP. I got the acronym wrong. Well, I got the acronym right. I got the first word wrong. Significant economic presence. Obviously, I need to understand what is it. Should we be concerned about it, and should taxpayers be concerned about it? And just talk a little bit about SEP.
Yeah, I think so. Look, in a sense, it's a broader version of a DST. What it does is it tries to address the perception, which is not unfair in some cases, the perception that the system is still very skewed towards large, rich, capital exporting residence countries and disadvantages developing countries in particular. And therefore, this is an attempt to get some of that back. And what the significant SEP does is to trip over my tongue. What the SEP does essentially is to say just lower the nexus threshold, and then effectively to impose tax on the income deemed to arise in the country. Now, the way it's set up is slightly different and interesting in a sense. So there are two big, relatively recent examples. One's Nigeria, the other's Kenya. And if you take the Kenyan model, so Kenya had a 3% DST. And the plan there was to abolish it in favor of a significant economic presence test. And that was at least badged as being a net income tax. Now, the net income was worked out on a formula, which, as luck would have it, was 30% of gross revenue taxed at 10%, which, just to do the math, works out at 3% of gross, which is neat. It's a sort of the same way around. It's a different way around the same sort of problem. But it's easier to flex because you don't need to define, or you define what the services are which are caught in a slightly different way. Again, the focus so far has been mostly on digital. But again, India, for example, had, in the past, looked at it more broadly. So, I think you can see that. But it does also get wrapped up in the wider debate about what's going on at the UN, which I think we're going to get to in a second. So, I think that SEPs are out there, but as I say, I think the UN process may take a slightly different tack on that, or not a different tack, but we'll treat it in a different way.
Yeah, and again, it'll be interesting as that continues to progress. I feel like there hasn't been a lot of noise in the U.S. or from the U.S. administration on that. I mean, given that it's a two, relatively smaller economies at this point, but one could foresee sort of similar issues that the administration.
Oh no,
US administration would have.
they would be, because I think that the argument. So remember that the 899, or at least originally, was discriminatory and extraterritorial. And the discriminatory, which was the DSTs, did focus on the size of the corporations which would be caught. So the SEPs would have to be careful in that context. I was carefully designed, I should say, in that context. But we don't know how that'll go for the moment.
All right, so you already teased the next topic. All this is flowing very nicely, just like we planned it will. What's going on
in the bubble?
Right. What's going on in the UN? I recently had a question from a taxpayer. Is this the end of the days with the OECD? Is Pillar 2 the death nail in the coffin, and the UN is now going to be the tax policy making body for the world? Well, what's your answer to that?
Yes and no. So, I mean, there is a fairly serious yes, which is that I think that we're past sort of peak OECD, let me put it like that. And not all because of the complexity and the things we don't particularly like about Pillar 2, but simply because, again, going back to those megatrends, the geopolitics, the protectionism, global fiscal crisis, all of those have made the achieving of a multilateral agreement, a true big multilateral agreement, much, much harder to do. And I mean, there are lots of other reasons as well. But, so I think we're past peak OECD. The UN is gearing up. And, even as we talk about the UN, and because it's a majority-based organization, majority voting-based organization as opposed to a consensus organization, it will get through whatever it wants to on this. But, the US walked out in January. The EU has maintained a very cautious approach to these negotiations, so have some other big developed non-EU countries. So, to the even if the UN gets something out, if you don't have that swathe of countries involved in it, then what have you achieved, at least to start off with? And there's a little answer to that, which is tax audit activity, because we know that gets influenced by what people talk about, even if it hasn't been ratified. But at least as a big matter. But equally, what you see is, once the convention is agreed, which isn't still for another 2 years, and then begins to be ratified another 3 or 4 years, and coming into effect, you will see it firstly affecting the tone and the content of the conversation, and I'll come to the substance of that in a second. But also, and I think I'm sure I've said this on your show before, but if not, I've said it in other places, which is I will be well retired by this point. But my sort of medium-term view on this is that you get in 5 or 10 years' time to something which was, to use a not perfect metaphor, something like the Cold War, where you have, so the USA and its allies on one side, the USSR and its allies on another side. And you have two blocs which are capable of negotiating with each other and making something stick. And I think that you have the OECD in the end, which represents, maybe it draws back to its 30-odd members. But you have the OECD, which essentially represents the point of view of, wealthy developed countries. And you have the UN, which represents the views of smaller, developing, various other things. Maybe it's more than one, maybe it's more than two. But did you actually have those two groups which cohere and which have their ideas? And then you have the possibility of things coming together. But if what you have is 140 countries or 210 countries or whatever, you're never going to get anything that works there. But we are a ways away from that, which means we have this 4, 5, 6, 7 years of uncertainty. But what the UN is talking about, particularly again relates to the taxation of services. And by, you can define services very broadly to include, essentially anything which involves IP as well. And what you're seeing here, at least in terms of the way they discuss it, is, there's the obvious one, which is simply gross withholding, a withholding tax on, service payments out. But there is also a sort of sub-discussion in parts of the UN about doing that on a net basis. Now, this goes back to what I was saying before about the significant economic presence test, which is that if you take 30% of 100% and then tax it at 10%, you get to 3%. Okay,
it's good math.
So that may not work. But there are, could you have variable formulas depending on what the profit margin was, things like that. This is a discussion to be had. But another take that people have taken on it, so that, that's the withholding tax. That still assumes that, under situation normal, what is actually happening is that, otherwise non-taxable income, because it's deductible, is paid from the source country to the residence country. But there are other people who are taking a different look at it. And just to name one of them, so Paul Oosterhuis, who we both know, great guy, good thinker, has been thinking about this quite a lot. And one of the ideas that he's playing around with is essentially that you do change the rules, the underlying rules, by saying, actually, this income is earned in this country. And therefore, it's not a question of withholding. The income's earned in that country, it's taxed in that country. And the question is, okay, well, how do you do that? And then you have to come up with a formula which says of X, whatever element of system profit you care to take, that X belongs to the source country and Y belongs to the residence country. And then it gets taxed in that country. So you don't have the questions of withholding. It should be a straightforward tax, which is, if the foreign tax credit system survives, is creditable in the other country. So again, but all of this at the moment is still very nascent. Sure. But you can see where the conversation's beginning to go. And, that I think is what the UN achieves. And, does the OECD try and get in on the game? May do. But I don't think they have quite the right constituency, at least at the moment, to do that.
And there's been some very vocal from the developing countries that feel like that the OECD has not adequately represented them. No. And that's where we're seeing, to your analogy between the US and the USA and the USSR.
Right.
You can see that they feel like the UN may represent their interest better. And who knows, in 10 years, I will not be hosting the podcast at this point. We will both be long retired.
I'll join you in your room at the retirement home.
I hope the podcast is still going, and our future generations can report on what has happened with the UN convention.
I will be listening avidly.
All right. Well, Will, always fascinating having you on. Very excited to learn some things and talk about a topic other than Pillar 2. And we'll sure to get you on as we learn more and hear more about the G7 agreement, what's going to take place with the side-by-side agreement and the other changes to Pillar 2. So thanks for coming on.
I'm aiming for episode 220.
Oh, yeah. All right. Well, thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Will Morris, PwC's Global Tax Policy Leader. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.